Welcome friends, in continuation with last class. So in this video we are continuation Ind AS 103, that is business combination. So up to 9 concept we are completed. Now 10th concept relating to price, purchase price allocations and their exceptions we will provided here. So recognition of assets and liabilities of the acquired entity. So here we will recognize the goodwill and net identifiable assets and liabilities whatever, and NCI portion will be required to provided as on date of acquisition data. For that recognition we will qualify the which are the items we will include here, and how we can consider and how we will calculate the this, and we will see the how we will classify these items, designation of derivative instruments, and assessments. So some measurement principles they are provided for this assets and liabilities recognition. So if you are acquirer shall measure the identifiable assets acquired and liabilities at the fair value and acquisition date. So whatever the amounts he will taken as per fair value. And for the business combination, the acquirer shall measure at the acquisition date component of NCI also. NCI means non-controlling interest, or as per existing as it will be minority interest, where here acquirer with the person ownership interest and how entitled their whole to proportionate share. So there we need to consider that persons also, who are the persons NCI, non-controlling interest persons. In the event net assets in the event of liquidation, either fair value or the present ownership instrument proportionate to share in the recognized amount in the identifiable assets. So for the purpose of calculation of goodwill we will consider net identifiable assets, non-controlling interest, and purchase consideration. If you have any previously held control we will also consider that one also. And for that they provided some exceptions. So first of all, exception to recognition measurement principles, which is for limited to acquisition date accounting. Here whatever the assets or liabilities which are otherwise which is not recorded, means like this contingent liabilities. For this contingent liability recognized if its fair value can be measured reliably. So contingent liability will be calculated as per Ind AS 37 provision, contingent liabilities and contingent assets. Normally we will consider fair value, but for that we are providing some exceptions. Means if you have any contingent liabilities, for that contingent liability only when you have measured reliability, then only we will consider that contingent liability. For that possible contingent liability means possible obligation arises from past events and whose existence will be confirmed only occurrence or non-occurrence of one or more uncertain events, not wholly within the control of the entity. Here we will see 2 points. One is possible obligation, another one is present obligations. So Ind AS 37 do not apply in the determination of contingent liabilities. So only the settlement resources are probable that outflow of resources is there, outcome will be provided. For that they provided the summary. Possible, if you have possible obligations, so it is not required to recognize as per Ind AS 37, and it is not required to recognize as per business combination also. So only possible obligation, it is not required recognition at any place. And if you have any present obligation and there is no probable that an outflow of economic benefit will occur, so you have obligation. Whenever you have obligation as per the business combination, if you are reliably measure that obligation, then you need to recognize it as per business combination. But as per Ind AS 37 it is not recognized. Whenever you have present obligation, that present obligation will have probable that outflow of economic benefit will occur but cannot be measured reliably. If you are not able to measure reliably, you cannot recognize it. This is one they are provided. And example number 15. So in example number 15, a suitable for damage worth 10 million was filed. So here one company is there and A is suited damage on company B 10 million was filed for alleging breach of certain contract provisions. So he breached some provisions. Company B has disclosed the same as contingent liability in its financial statements. So A sues 10 million and company B in its financial statement shown as contingent liability. It is considered that it is present obligation for which it was not probable that the amount would be payable. So they are considering it has present obligation, but it is not probable that the amount would be payable. Now company A acquire company B. So this only ordered alleged breach of certain contract provisions. Now it is purchasing this company B, and whenever they are purchasing, company A acquire company B and determine the fair value of contingent liability. This 10 lakhs value has and date it will be fair value of 2 millions. Now company A would recognize 2 millions in its financial statement as part of acquisition accounting. So even it is not probable that payment will be required to settle obligation. So company A will be recognized only 2 millions in the financial statements. Another assets, some assets and liabilities which will be measured value other than acquisition date fair value. Here we should see some both recognition and measurement exceptions and one measurement exception. So for both recognition and measurement exception we have 4 items. So it will be income tax and employee benefits, indemnification assets and lessee in which the acquiree is the lessee. So for that we need to follow respective standards. For income tax we need to recognize and measure as per Ind AS 12, and whereas employee benefits we need to recognize and measure as per Ind AS 19, and indemnification of assets recognize and measure at the acquisition date at its fair value based on that, and lessee in which the acquiree is the lessee if he is a person recognizing any ROU assets. So indemnification of assets, here who is the person recognizing the ROU asset, and lease liabilities as per Ind AS 116, but here some exception will be provided for short term lease or if it has low value lease. Here we will measure the lease liability by using the present value of remaining lease payments as per new lease at the acquisition date. So as on the date of acquisition date we will see the what is the value, and we will consider that time value and present value of remaining lease payments, and we also measure the ROU asset and same amount as lease liability. These all are for both recognition and measurement exceptions were provided. Now example number 16, they provided one example number 16. In example number 16 they are explaining about company A is there, company A is there and company B is there. Company A acquired company B in business combination on 1st April 2001, means 1st April 2001 became the date of acquisition, and B is being sued by one of its customer for breach of contract for 250. Here B sued one of its customer for breach of contract for 250 rupees. Now the seller of B provided indemnification to A for reimbursement of any loss greater than 100. So he has acquired the business. So if they are entered one agreement, if the person any indemnifications reimbursement given, and if it has greater than 100 then the person will be payable with the person provided that there is no collectability issue around this indemnification. So as on the date of acquisition company A determined that there is present obligation and therefore the fair value of contingent liability will be 250. So now company A is purchased and company A has their liability, so it is required to recognize that contingent liability of 250 lakhs and as on the date of acquisition, and it has collecting from the amount from company B, that is up in excess of 100 rupees, means 250 minus 100, 150 rupees will be the indemnification of asset. So 150 will be the indemnification of asset and 250 will be the contingent liability. In balance sheet we need to recognize separately. In profit and loss account, if you want you can set up, no problem. And illustration 15. Here in illustration 15 they provided one company, APG Limited acquired beverage company of PQR Limited from XYZ company. So it is acquired beverage company of PQR Limited from XYZ. So from XYZ it has purchased. At the time of acquisition, PQR Limited is defendant in the court case where certain customers of PQR Limited have alleged that its products contain pesticides in excess of permissible limits. So they are provided some items, that items contain some insecticides, that is pesticides, which is more than the permissible level. Now that for that reason some persons was caused some health damages. Now PQR Limited is being sued for damages of 2 crores. So sued for 2 crores in the court, where XYZ has indemnified ABC Limited for losses, if any, due to the case for amount up to 1 crore. If the amount is up to 1 crore, he will provided, and the fair value of contingent liability of the for the court is 70 rupees. So up to 1 crore they are provided their amounts. So they are given the contractor, so they are agreed to provide up to 1 crore. So as on the date the fair value will be 70 lakhs. Now it will be provided as indemnification asset. And how should ABC Limited account for contingent liability and indemnification of asset? What if the fair value of the liability is 1.2 crores? If it is amount more than 1 crore, then it will not get any indemnification of assets, because they agreed only up to 1 crores. Now they will only up to 1 crore. So in the current scenario, ABC Limited measure the identifiable liability of entity PQR Limited at 70 lakhs and also recognize corresponding indemnification assets of 70 lakhs. So in consolidated balance sheet they have contingent liability and indemnification assets for both amounts, whereas in consolidation the net impact on the goodwill for recognition of the contingent liability and asset indemnification assets will be nil. And however, in case where the liability fair value is more than 1 crore, then 1.2 crores indemnification asset will be limited to only 1 crore. So current liability means that contingent liability it will become 1.2, but the indemnification of assets will be 1 crore only. Next, illustration number 16. In illustration number 16, ABC Limited pays 50 crores to acquire PQR Limited from XYZ. So A is there and paying 50 crores to PQR. They are purchased from XYZ company and manufacture product containing fiber glasses and have been named 10 class actions concerning the effect of these fiber glasses. XYZ Limited agreed to indemnify ABC Limited for the adverse results of any court cases up to amount of 10 crores. So up to amount of 10 crores, if you have any adverse, they will assure that amount will be payable by that company. Now the class actions have not specified amount of damages, and past experience suggested that claim may be up to 1 crore each, but that they are often settled for small amount. Now ABC Limited makes an assessment of the court cases and decided to that due to potential variance in the outcomes, the contingent liability cannot be measured reliably, and accordingly no amount is recognized in the court cases. How should indemnification assets would be accounted? When you are not recognizing any contingent liability, then ABC Limited is not recognized any indemnification assets. So indemnification asset will arise only if you are recognizing contingent liabilities. If you are not recognizing any contingent liability, you are not required to provide indemnification assets. And after that we have, for measurement we have some exceptions, that is reacquired rights and intangible assets and some state based payment transactions. For reacquired rights, we will measure based on the remaining contractual terms of the related contract. So we will see the related contract and we will see the remaining contractual terms. On that basis we will measure the here. And asset held for sale, it will be dealing asset held for sale and discontinued operation will be dealing by Ind AS 105. Here measured as per Ind AS 105 at the acquisition date at fair value less cost to sell. Normally in business combination 103 we will account as per fair value, but we are not following the fair value here because they have separate standards. Whenever the activity is dealing by other standards, we will consider based on that standards. So that assets held for sale we will consider fair value less cost to sell. And if we have any share based payment transactions, for that share based payment transaction we will go with the as per Ind AS 103 at the acquisition date. These are provided, and if you have any assemble values will be provided, and workforce provided. So exception to recognition of measurement principles. Next here intangible assets. In intangible assets it will be dealing intangible assets Ind AS 38 I think so, and here for goodwill it either separately criteria is met or it has arised from contractual agreements. So for recognition of intangible assets in business combination transaction meet the definition of asset. Means intangible asset definitions, it must be identifiable and it must have expected future economic benefits and control over the assets. So this definition must be satisfied, then only we will recognize the intangible assets. One is identifiable and control over the asset and it has future economic benefits, then only we will recognize the intangible assets. As per Ind AS 38, asset is identifiable. Here they provided identifiable either by contractual or legal criteria or separate criteria. If may have contractual legal criteria, for example they provided the example, an acquirer owns and operate nuclear power plant. So it has nuclear power plant, is a nuclear power plant. Now the license operate that power plant is intangible assets, so the license it will be intangible assets. Now the asset will meet the contractual obligation criteria for recognition separately from the goodwill. So they provided that license have separate identity, so we need to separate from the goodwill. Even if the acquirer cannot sell or transfer it separately from the acquired power plant. So if you want to sell power plant, you can sell without selling this license. And an acquirer may recognize the fair value of operating license and fair value of power plant as a single asset for financial reporting purpose if useful life of these assets are similar. So for the property plant plus the operating license we will recognize it based on their fair value. And second example, an acquirer owns some technology patents, so it has licensed that patent to other for their exclusive use outside the domestic market or receiving specified percentage of future revenue in foreign exchange. So if you are exporting some items, if you are exported some exclusive product to other side country, or if you are meet the foreign exchange revenue criteria, then you are eligible for that license. Both the technology patent and the related license agreement meet the contractual legal criterion for recognition separately from the goodwill. Even if selling or exchanging patent and related license agreement separately from one another would not be practical. Next, separability criteria. Here for if you have any intangible asset, it is capable of being separated or it is divided from the acquiring, then we will see how we can sold or how we can transfer, how we can license, rented or exchange. Either it will be individually or together with the related contract or together with the identifiable assets or together with the some liability we will consider. Now if you have any intangible assets that the acquirer is able to sell or that license something else value meet the separate criteria, then acquirer does not intend to sell or otherwise exchanged. So acquired intangible assets meet the separate criteria. So for if you are purchase one asset na, if you have, then you have the purchase value. If you are internally generated, you do not have the value. So we will consider whether it will be internally generated or purchased from the business. For that they are provided one example: customers and subscribers listed for frequently licensed and thus meet the separability criterion. Even if the acquiree believes its customer list have characteristics different from other customers. So here customers and subscribers, they are listed and they are frequently licensed and they have some separate criteria. But even acquiree believes its customer list, which have characteristics different from the other customers. List will be list. So if you went into the market, you can get the customer list. And if the customer list are frequently licensed, generally mean that acquired customer list meet the separate criteria. However, customer list acquired in a business combination would not meet the separability criterion, because customers may change from the business to business, and in terms of confidentiality or some other agreement prohibit an entity for selling or leasing or otherwise exchange the information about its customers. So all companies, they do not sell their customer list, so it is not how any meet the separate criterion. In intangible assets which is not individually separable from the acquiree or combined entity meet the separability criterion. For example, they provided market participants is there, which is exchanging deposit liabilities and related depository relationship. Intangible assets is observable exchange transactions. So we will discuss what is this observable exchange transactions in India AS 113 fair value measurements. Therefore, whenever the acquirer is taking, he should recognize the depository relationship intangible assets separately from the goodwill. Or in an acquiree owns some registered trademarks and documented but unpatented technical expertise used to manufacture the trademark products. To transfer ownership of trademark, the owner is also required to transfer everything else necessary for the new owner to produce the product or service indistinguishable from that produced by the farmer. So I do not have the unpatented, I have unpatented technical expertise and trademark, registered trademarks. But whenever he is selling, he need to sell all items, he need to transfer all items, because of unpatented technical expertise must be separated from the acquiring or combined entity, and the sold if the related trademark is sold, it meets the separability criterion. Now accordingly we will see what is the possible source of information, which indicator used to identify any possible intangible assets separately from the goodwill or non. So for that we will see what is the internal source of information, and we will see the information. For that internal source of information, we will see the financial statements. So in financial statements of acquiry, if you have any R&D, so we will see for the R&D, research and development, okay, whether we can bifurcate or not. Is there any intangible assets? So for research we can capitalize it, or development stage we can transfer to profit and loss account. Whether the it meet the criteria, then only we need to capitalize it. If the criteria is not met, we need to transfer it to profit and loss account. And if you have any significant sale promotions or marketing costs, this is strong indicators of marketing. Whatever the advertisement expenditure, it is for future purpose, but we cannot amortize the advertisement amounts. So the advertisement amount we need to charge it to profit and loss account whenever we are incurring. Next, cost acquisition cost, that is lot of companies spend money to acquire new customers, like online e-commerce companies provide some incentive to register customers for the first time, and for downloading their app they will provide some sign up amounts. This may be strong indicators of existence of customer list as an intangible. Next, share price agreements. If you have any purchase acquisitions, so these all are the information which will be separable from the goodwill. For example, illustration number 17. Company A, which is FMCG company, acquires an online e-commerce. So it has acquired company E with the intention to start it a retail business. Now e-commerce company has over the period have 10 million registered users. So for this E has 10 million users, and however the e-commerce company E does not have any intention to sell this customer list. So this 10 million persons list, it is not selling to customer A. Should this customer list be recorded as intangible assets in business combination or not is the question. Firstly, in this situation, customer database does not give rise to legal or contractual right. So here the company is not providing, so you do not have any legal or contractual right to get that customer database. Now accordingly the assessment of its separability will be assessed. So now we will see from the business we can separable that item. The database can be useful to other players, and company he has the ability to transfer this them. So it the whatever the millions 10 millions person data, company E able to transfer to other, and the other players may use these customers. Accordingly the intention not to transfer will not affect the assessment whether to regard this as intangible or not. Now hence customer list should be regarded as intangible in business combination. So it has separable criteria has met, and it will be regarded as intangible asset. And in illustration number 18, for illustration number 18, ABC Limited, one ABC Limited is there, and pharmaceutical group, it has purchased acquired XYZ, another pharmaceutical business. XYZ has incurred significant research costs in connection with two drugs. So in connection with two drugs that have been undergoing clinical trials. Out of two drugs, one drug has not been granted necessary regulatory approvals. So it has two drugs. For two drugs, one is I B, and one has does not came the regular approval has on day, and another one is have regular approval from the government. However, ABC Limited expects that approval will be given within 2 years. The other drug has recently received regulatory approval. The drug revenue earning potential was one of the principal reasons why entity ABC decided to acquire. So why it is purchasing? Because some one is got the approval and it is able to generate the revenue. Other he is not get the license as of now. It is not get any revenue as of now. Now, whether the research and development on either of the drugs would be recognized as intangible assets in the books of ABC Limited is the question. So, firstly, when you are dealing with Ind AS 38, that is intangible assets, Ind AS 38 will deal Ind AS intangible assets, which is provide explicit guidance on recognition of acquired in the process R&D. So if you have any process R&D, it will provide the guidance. Ind AS 38 will provide the guidance. Here Ind AS 38 provide guidance regarding general recognition conditions which require to probable that economic expected future economic benefits will flow to the entity before intangible asset can recognize and cost should be measured. So for intangible assets we need to recognize only we have satisfied the three conditions. One will be we can identifiable, and another one will be cost will be measured reliably, another one will be economic benefit, future economic benefit will arise, probable will be there. then these three condition is satisfied, then only we need to recognize the intangible assets in the books of account. Now as per para 33 Ind AS 38, both the standard general recognition criteria, probability of benefit and reliable measurement are always considered to be satisfied for intangible assets acquired in business combination. Now for intangible assets, we can recognize using the fair value of intangible assets, which reflect the probability, which recognizes the provisions. So here fair value of intangible assets is provided, and we need to see whether the sufficient information to measure the fair value of assets reliably, if it is separable or arises from contractual or regular source. So what is the fair value? Is there any uncertainty about the timing or amount we can see as on that date? If you have any uncertainty is taken in the accounts of measurement of the assets fair value. And Ind AS 38 provides guidance, means accordance with Ind AS 103, acquirer need to recognize it at an acquisition date and from the separately from the goodwill and intangible assets of the acquiring, irrespective of whether the asset has been recognized by the acquirer before the business combination. This means for acquirer need to recognize the asset separately from the goodwill and in process R&D project of the acquirer if the project meets the definition of intangible assets. So for the intangible asset definition, we should see the three items. One is identifiability, and cost should be measured reliably, and whether the future economic benefits will be getting from that asset. For if we satisfy these three conditions, we can recognize the intangible assets. This means that the acquirer recognize the assets from separately from the goodwill in process. If it is in process also, the R&D project of the acquirer, if the project meets the definition intangible asset, the acquirer in process R&D project meets the definitions. So it is identifiable. Identifiable means separable or arise from the contractual or other rights. In accordance with the above, first drug, which is first fair value of the first drug, reflect the probability and the timing of regulatory approval being obtained. So first drug is came and regulatory approval also they are ready to approve as per the standard recognition criteria, that is probable future economic benefit is satisfied in the drug 1. The asset are required accordingly, asset need to be recognized, whereas subsequent expenditure in process R&D we need to charge it to profit and expenses. So up to that expenditure we need to charge the amount. Project acquired separately to be dealt, whereas the right of second drug also meet the recognition criteria and also recognized the approval, means it is probable that future economic benefit will flow to ABC Limited. This will be reflected in fair value assigned to intangible asset. Now the whenever we are recognizing in process R&D and an asset of acquisition applies, different criteria will be used for internal projects. The research cost of internally R&D projects may under no circumstances be capitalized as an intangible asset, because it may be pertain to entity recognized as an asset some R&D expenditure that they would not have been recognized, because if it is internally project we should not recognize the all amount, although the amount attributable to project is accounted for an asset in the AS 38. Require any subsequent expenditure incurred after the acquisition of project will be accounted in accordance with Ind AS 38. Next, after that, assembled workforce of other items that are not identifiable. This is we are in acquiring, the acquirer subsumes some goodwill value of the acquired intangible. Here we will see the acquirer. For example, acquirer may attribute value to the existence of assembled workforce. Whoever the workforce is there, the employees we are assembling existing, and which is existing collection of employees that permit the acquirer to continue to operate an acquired business from the acquisition date. Now the assembled workforce does not represent the intellectual capital of the skilled workforce. So whoever the persons, whoever they having specified knowledge, whoever having experience of employees of the acquire bring their job here. So because of this assembled workforce, not identifiable assets, then separate from the goodwill, and any value attributable it will be subsumed into goodwill. And here the acquirer need to also subsume into goodwill any value that is does not qualify as asset acquisition. So if it is not how separate identification as an asset, then it will be subsumed into goodwill. For example, they provided acquirer might attributed some value of potential contact the acquiree in negotiating the prospective new customers at the acquisition date. Because of these potential customers are not themselves asset at the acquisition date. So we have customers, we have contacts, but it does not become the asset, because asset definition means you have right and you will get the probable future economic benefits. So you do not have the right here. So the acquirer will need to see as on the date the acquirer does not recognize them separately from the goodwill. The acquirer should not subsequently reclassify the value of these items from goodwill for events that occur after acquisition date. However, the auditor should assess the fact and circumstances. So always he will see the assess the fact and circumstances whatever surrounding the events occurring shortly after the acquisition to determine whether the separately recognized intangible assets exist at the acquisition date. After initial recognition, if an acquirer assets for intangible assets acquired in a business combination in accordance with provisions of 38. So firstly, as per Ind AS 103, it will deal business combination. If it has recognized any intangible asset, it will be subsequently accounted as per Ind AS 38. So in Ind AS 38 we can see if you have any goodwill, we will see the impairment test for every year. It is mandatory. Even though you do not have any indications, we need to test for impairment if you have any goodwill. However, decided in the year 38 good accounting for some acquired intangible assets after initial recognition prescribed by other standards we will consider. For the identifiable criteria, determine where an intangible asset is recognized separately from goodwill. If you are recognizing separately from the goodwill, however, the criteria neither provide guidance for measuring the fair value of an intangible asset nor restricts some assumptions used in measuring fair value of intangible assets. For example, acquirer would take into account some assumptions based on the market participants would be using pricing of intangible assets. So some expectation of future contract renewals and measuring the fair value. It is not necessary for the renewal themselves to meet the identifiable criteria. Even though they are not meet, we will provided. Next, here after that reacquired rights. For reacquired rights, we will see what are the part of business combinations. What are the acquirer going to reacquire? If we have any reacquire right, how can we accounting in the books of accounts? So here acquiree is granting one or more acquirer is recognized or unrecognized assets. For example, if you are selling one laptop and you have right to reacquire that laptop, it will become reacquired right. Now for example, they provided one example. A such right includes a right to use the acquirer trade name under a franchisee agreement or right to use the acquired technology under technology license agreement. Now a required right is identifiable intangible assets that the acquirer recognizes separately from the goodwill. So when you are separately identifiable reacquired right is there, we need to indicate separately. We should not add to goodwill. So in terms of if the terms of conduct gives provides any reacquired rights, whether it may be favorable or unfavorable relative to the current market transactions for same or similar items, the acquirer need to shall recognize the settlement gain or laws. They provided illustration 19. So in illustration 19, one company is there which is Vodpower Limited. Is a successful company, has number of own stores across India and also offers franchise to other companies. So they are providing franchise to other companies. Efficiency Limited. So one company is there. Efficiency Limited is one of the franchisee of Vodpower Limited. So it is one franchisee for Efficiency and it operates number of stores in South India. Vodpower Limited decided to acquire Efficiency Limited. Now it is the franchisee. Now Vodpower is want to acquire that efficient due to its huge distribution. So this efficiency have some huge distribution. Because of that huge distribution, Vodpower is required want to purchase that Efficient Limited and accordingly purchase the outstanding shares on 1st now April 2022 and the acquisition date. Vodpower determine that license agreement reflect current market terms, determine accounting for franchisee right by Vodpower at the time of acquisitions. Now Vodpower will be regarded franchisee rights as an intangible assets. So it has intangible assets which have reacquired right while doing purchase price allocation, and it has since market terms are no gain or no loss will be recorded on the settlements. Next, if you are in illustration number 20, in illustration number 20, ABC Limited is there, ABC company, and it has acquired PQR company for consideration of 1 crore. It is for 4 years ago. Okay, ABC Limited granted some 10 years license allowing PQR Limited to operate in Europe. So they are allowed one license which is granted for 10 years. Now 4 years was completed and unexpired will be 6 years. The cost of license was 2,50,000. So the cost will be 2,50,000. Contract allows either party to terminate the franchise at cost of unexpired initial fee plus 20%. So here unexpired fee we need to calculate that unexpired fee. For unexpired fee the amount 2,50,000 will be the cost and remaining unexpired time will be 6 years into 6 divided by 10. That amount will be equal the unexpired unamortized value. So 2,50,000 into 6 by 10, it will become the unamortized value, and at the date of acquisition the settlement amount will be 1,80,000. They provide the settlement amount also 1,80,000. Now ABC Limited has acquired PQR Limited because it seems high potential in the European market. So now ABC Limited acquired the PQR Limited because they have European market and wishes to exploit it. ABC Limited calculated that under current economic conditions and current prices, it would be granted 6-year franchise for 4,50,000. So what is the price? 4,50,000. Now as per India, the acquirer and acquiree may have relationship that existed before they are contemplated the business combinations. So it is pre-existing relationship. So we need to see whether the relationship has any pre-existing relationship. Now here in this question they provided the pre-existing relationship between the acquirer and acquiree may be contractual. So for example, vendor and customer, they have relationship, and where licensor and licensee they have relationship. If are non-contractual, that is plaintiff and defendant, they are relationship. So this type of relationship person entering into transactions means it have pre-existing relationship between the acquirer and acquiree. For pre-existing non-contractual relationship such as lawsuit, we will go with the fair value. If it is non-contractual relationship, we will go with the fair value. But if you have pre-existing contractual relationship, we will go with the given below for lesser amount. So what is the amount they are provided? Whatever the amount they are giving here, the amount will be using the value. So here they provide the amount which is the contract is favorable or unfavorable from the perspective of the acquirer when compared with the current market transaction. So here we will take the current market price, and for the same or similar items. It may be favorable or unfavorable, or the amount any stated settlement provision in the contract available to the counterparty to whom the contract is unfavorable. If it is there any settlement provision, we will consider that one. So for that we have provided the amount they are given in year. So firstly the amount will be, it will become lower of the amount. For lower of the amount we will consider the values, comparing the values. So firstly the termination amount, so termination amount will be 1,50,000. so the settlement amount will be 1,80,000, or another one will be 2,50,000 into 6 10 plus 20%, it will become 1,80,000. And amortized portion, so amortized portion 2,50,000, so 2.5 into 6 by 10 amortized portion value. So here amortized provision value, it will become 1,50,000. So amortized portion will be 1,50,000, whereas provided the amount, whatever the amount they are provided, similar rights amounts will consider. For similar right amount it will be 4,50,000. so 6 years franchise 4,50,000, this is current market price. So 4,50,000 minus 1,50,000, it will become 3 lakhs. So 3 lakhs or 1,80,000, whichever is lower, it will become the 1,80,000 will become the last settlement contract value. So here they provided the pre-existing non-contractual relationship. If you have, we can directly see the fair value. If it is pre-existing contractual relationship, so for that they provide the examples. For if your existing relationship will be contractual or non-contractual. So for contractual means they provided vendor and customer, a licensor and licensee, where non-contractual means plaintiff and defendant. In our question, ABC Limited acquired Speakware Limited, means here they have some relationship and they are customer and means vendor and customer relationship, that is contractual relationship. So for using this formula we need to calculate the amount. Different is included as part of the business combinations. Now the amount of gain or loss recognized may depend on part of whether the acquirer had previously recognized any related assets or liability and reported gain or loss that may be different from the amount calculated by applying the above requirements. If your any recognition is there in past, we need to adjust that amount. If you are not any there, we will accordingly recognize. So in the instant case, license is recognized at 4,50,000. The fair value at market value of license based on the remaining contractual life, which is provided 6 years franchise for price will be 4,50,000, and gain or loss settlement of the contract will be lower of, that is lower of 4,50,000 minus 1,50,000. 1,50,000 will be amortized value which is granted. 2,50,000 into 6 by 10, it will become the 3 lakhs amount, which is the amount by which rights is unfavorable to ABC Limited. And another one will be settlement amount. 1,80,000 will be the termination right on the date of acquisition. So 1,80,000 will be the loss, whichever is lower it will become 1,80,000. 1,80,000 will be the loss. Therefore out of the 1 crore paid, 1,80,000 will be loss, it will be deducted, and 98.2 lakhs will be accounted as consideration for business combination, and 1,80,000 is accounted for separately as settlement loss in the reacquired right. Now the 10.5, it is goodwill and recognition measurement. Goodwill and recognition measurement. For goodwill and recognition measurement, we need to recognize goodwill at the date of acquisition data. We by using the method, which is we can see whenever excess of A versus B. In excess of A or B, A will be considered purchase consideration as on the date of acquisition date and NCI amount, and business combination achieved if you have any previously L amount, we need to consider that one. If we have more than this amount, net acquisition date, identifiable assets, acquired assets and liabilities assumed method in accordance with Ind AS. Whereas in business combination in which the acquirer and the acquiree exchange only equity interest, the acquisition date fair value of the acquirer equity interest may be more reliable method than acquisition date fair value of the acquiring. So goodwill will be calculated. Whereas bargain purchase means here the business combination in which the value of net assets is exceed the above. So net assets exceed the purchase consideration plus NCI or plus previously L is provided here. For example, they provided in example 18. In example 18, entity X is there. Entity X is the one of the X is their largest liquor manufacturing company in the world. It acquires another entity Y, which is present in the India and UK. However, the Competition Commission in UK has issued order to sell one division of UK assets of entity Y in order to comply with the local competition regulations in UK within a specified timeline. Because of that regulation, they are selling. Now, entity Z is another boutique liquor manufacturer realized the opportunity and purchased the assets of the entity Y from entity X. In the given case, it may more likely than not the could be an element of bargain purchase because they are not selling as of their own, they are selling as per the requirement of government, so they may get bargain purchase as of now. For the purpose, the acquirer need to review the procedure. Whenever we have bargain purchase, we need to identify the reasons. What is the reason will be the getting the amounts, and we need to reassess whether it is correct or not, and we need to review the procedure they are used. So identify the assets and non-controlling and business consideration. What is the consideration transfer? So we need to identify the reason, we need to reassess whether correctly identified or not, we need to review the procedure. And illustration number 21, in illustration number 21 they provided one company is there, that is company A is there, and acquired 80% in B. So acquired 80% in B in exchange for cash 15 crores. So the former owner of B Limited were required to dispose of their investment in B Limited by a specified date, and accordingly they did not have sufficient time to find potential buyers. A qualified valuation professional hired by management of A Limited measures the identifiable net assets acquired. So in accordance with the requirement of Ind AS 103 at 20 crores and fair value of 20% NCI will be 4.2 crores. So for 80% they are paying 15 crores. So this is purchase consideration, and net identifiable assets it will be 20 crores. Net identifiable assets it will be 20 crores, and for fair value of NCI will become 4.2, means 19 15 4.2 it will become 19.2, whereas N20 will be the net identifiable assets. So it is less than this one, means net identifiable assets is greater than this one. So here for the purpose of this we will get the gain on bargain purchased. The amount B Limited identifiable net assets will be 20 crores, exceed the fair value of amount consideration transfer plus fair value of NCI. Therefore, A Limited should now review the procedure. It is used to identify and measure the net assets acquired and fair value of NCI in B Limited, and consideration. What is the consideration? They are transferred. After review, A Limited need to decide the procedure and resulting measure will be appropriate, and A Limited will need to measure the gain of purchase of 80%, that is 80 lakhs, difference between the identifiable net asset 20 crores and sum of purchase consideration 19.2. It will become 19.2. Cash consideration 15 plus NCI fair value. So cash consideration is for 80%, NCA is for 20%, it will become 100%, and net identifiable assets are provided for 100%. So we will see the what is the amount they are provided. It will be transferred to capital reserve. And if we choose another method, so for we have two methods, one is fair value method, one is proportionate method. So here we are calculated using the fair value method. If you want go with the proportionate method, what is the net identifiable asset? On that net identifiable asset, 20% will be calculated, that will be used for calculation, and we will get the gain on bargain purchase. It will be 1 crore rupees. Now measurement period. I think this measurement period will be discussed in next video.